It is the single most brutal and persistent statistic in all of finance. Approximately 95% of all retail traders consistently lose money and ultimately fail. It is a number so staggering that it seems to defy logic. In an era of unprecedented access to information with powerful charting tools available to anyone with an internet connection, why does such a vast majority of participants fail so spectacularly? The common answer is that the market is a complex, unpredictable, and rigged game. But the truth, as the market's greatest legends have consistently demonstrated, is far more personal and far more profound. The market is not the problem. The primary source of failure is not external but internal. This is a deep forensic analysis of that failure. It is a post-mortem on the common, predictable, and ultimately avoidable errors that lead to the ruin of the 95%. But this is not just a catalog of mistakes. For every fatal sin committed by the losing trader, we will provide the powerful antidote, the specific, time-tested principle used by a legendary operator to turn that very weakness into a strength. This is not a theoretical discussion, it is a practical playbook. We will deconstruct the foundational, strategic, tactical, and psychological errors that define the losing trader, and we will provide the corresponding frameworks that define the winner. This is the definitive guide to understanding why traders lose, and the actionable steps required to join the winning 5%. This journey into the core principles of professional operation is the central mission of this channel. It is a commitment to deconstructing the methods of the masters to provide you with a real, evidence-based education. To ensure you receive every part of this deep analysis and continue to build your own professional framework, we invite you to subscribe to this channel and click the notification bell. The first and most foundational sin that guarantees a trader's failure is the complete absence of a professional plan. The losing trader, the amateur, approaches the market as a gambler approaches a casino. They are drawn by the allure of action, the thrill of the bet, and the intoxicating promise of fast, easy money. Their process, if it can be called that, is one of impulse and reaction. They hear a tip from a friend or see a story in the news about a hot stock and they jump in, driven by a fear of missing out. They have no predefined thesis for why they are buying, no clear criteria for when they will sell, and no concept of how this single trade fits into a broader portfolio strategy. Their trading is a series of disconnected, hopeful punts. They are, in essence, operating without a map in the most dangerous and unforgiving territory on Earth. The antidote to this fatal impulse is the professional mindset, a philosophy perfectly embodied by the lone wolf of Wall Street, Bernard Baruch. Baruch, who built an immense fortune from a small starting stake, treated speculation not as a game but as the most serious of business endeavors. His first and most important principle was to get the facts. Before he ever committed a single dollar, he would conduct an exhaustive, almost obsessive investigation into the object of his speculation. He understood that a trade based on a tip or a headline was a trade built on a foundation of sand. A durable edge could only be found through deep, independent research. If Baruch was interested in a copper company, for example, he would not just look at its stock chart. He would become a temporary expert on the entire global copper market. He would study the production figures from the world's major mines. He would analyze the industrial demand from the burgeoning electrical and automotive industries. He would investigate new technologies that could affect supply or demand. And he would assess the character and track record of the company's management. He was building a complete, multi-dimensional picture of the entire economic ecosystem in which the company operated. This deep, fact-based thesis was his plan. It provided him with the answer to the most critical questions. Why am I buying this? What are the specific, fundamental reasons I expect it to appreciate in value? This process is the absolute polar opposite of the gambler's impulse. It is a slow, laborious, and often tedious process. But it is this very work that creates the psychological fortitude required for success. When a trader has a plan built on a bedrock of facts, They are not easily shaken by the market's meaningless daily fluctuations. A scary headline or a sudden 5% drop does not induce panic, because their conviction is not based on the market's fleeting mood, but on their own deep understanding of the business's long-term prospects. The losing trader, having entered on a whim, has no such anchor. At the first sign of trouble, they are consumed by fear and doubt because they have no underlying reason to hold their position. The first and most critical difference between the winner and the loser is this. The loser comes to the market seeking action. The winner comes to the market only after they have completed a plan of action. The second foundational sin that dooms the majority of traders is the failure to respect the overall market direction. The losing trader is a stock picker in a vacuum. They become obsessed with the story of a single company, with its new product or its promising earnings, and they completely ignore the state of the broader market. They are the proverbial sailor who meticulously polishes the brass on their ship while ignoring the Category 5 hurricane bearing down on them. They will find what they believe is the perfect undervalued growth stock and buy it, only to watch in bewilderment as it gets pulled down in the vortex of a new bear market. They conclude that they were unlucky or that the stock was a fraud. They rarely conclude that the true mistake was simply trying to swim against a powerful, all-encompassing tide. The antidote to this strategic blindness comes from the work of William J. O'Neill, the founder of Investors Business Daily and the creator of the CANSLIM system. O'Neill, through his massive historical study of the market's greatest winning stocks, discovered an undeniable truth. Approximately 3 out of every 4 stocks, regardless of their individual merit, will move in the same direction as the overall market. This led him to make the letter M, market direction, the single most important component of his entire system. For O'Neill, analyzing the general market was not an optional extra. It was the mandatory first step of any successful investment operation. His method for gauging the market's health was, like all his work, based on the direct empirical evidence of price and volume action. He was not interested in the opinions of economists or the forecasts of Wall Street strategists. He watched the daily action of the major market indexes, like the S&P 500 and the NASDAQ Composite, to determine if they were in a confirmed uptrend or under pressure. He identified the start of a new bull market with a specific signal he called a follow-through day. This occurs when, after a period of decline, a major index has a powerful rally of 1.5% or more on a volume that is significantly higher than average. This signal, occurring on the 4th day of a new rally attempt or later, was his historical indicator that the market had successfully shifted from a downtrend to a new, sustainable uptrend. It was only after this confirmation that he would even begin to look for individual stocks to buy. Conversely, he identified a potential market top by counting what he called distribution days. A distribution day is a day when a major index closes down on a volume that is higher than the previous day. This is a sign of institutional selling, of the smart money unloading their shares. A single distribution day is meaningless. But when O'Neill saw a cluster of 5 or 6 of these days over a period of a few weeks, he saw it as a major red flag that the uptrend was in jeopardy, and he would begin to sell his positions and raise cash. This disciplined top-down approach is a defining characteristic of the winning trader. They understand that even the strongest ship can be sunk by a powerful storm. They respect the power of the overall market and patiently wait for its powerful tailwind to be at their back before they ever set sail. The losing trader, in their myopic focus on their single stock, never even sees the storm coming. This deep analysis of a company's fundamentals and the market's overall structure is the hallmark of a professional operator. It requires a deep and dedicated study of these nuanced principles. Recognizing this, and to further aid the serious student of the market, we have created a new, dedicated resource. Richard Wyckoff was not just another trader on Wall Street. He was the first to systematize the hidden logic of the market. It was he who explained how supply and demand create the repeating cycles of accumulation and distribution that are still in effect today. To explore these principles more deeply and to go step by step through the market phases and rules of Wyckoff, we have created a separate channel, Richard Wyckoff Trading Methods. We invite you to subscribe. A link is in the description. The ability to combine a professional framework with an understanding of market mechanics is the key to a durable edge. Having now established the two foundational pillars of a professional operation, a specific plan for each trade and a strategic awareness of the overall market, we must now turn to the more subtle but equally fatal errors that occur in the realm of analysis itself. This is the domain of strategic sins, where a flawed interpretation of the market's evidence leads even the most prepared trader astray. The third, and perhaps most intellectually insidious sin, is the failure of a trader to subordinate their own opinion to the market's objective action. The losing trader is often an intelligent individual, capable of conducting extensive research and forming a brilliant, compelling thesis about a particular stock or the direction of the market. They become intellectually and emotionally invested in this thesis. The problem arises when the market, through its price action, begins to disagree with them. The stock they believe should be rising begins to fall. The market they believe should be crashing continues to climb. Faced with this direct, contradictory evidence, the losing trader does not question their own judgment. Instead, they conclude that the market is wrong, that it is being irrational, and that it will eventually, inevitably come around to their superior point of view. They hold on to their losing position, not based on evidence, but on the pure egotistical belief that they are right and the millions of other market participants are wrong. They are, in essence, arguing with the ticker tape, an argument that is always eventually lost. The antidote to this fatal intellectual pride is the core philosophy of the man who considered the ticker tape to be his one true guide, Jesse Livermore. His entire operational framework was built on a foundation of profound humility before the market's verdict. He famously stated, "The market is never wrong, opinions often are." This was not just a clever aphorism, it was his central guiding principle. He understood that his own analysis, no matter how carefully constructed, was merely a hypothesis. The ticker tape was the experimental result that would either validate or, more often, falsify that hypothesis. His job as a speculator was not to impose his opinion on the market, but to listen to the market's opinion and align himself with it. Livermore's method for achieving this egoless state was his relentless focus on the pivotal point. As we have discussed, a pivotal point was a critical price level, often a breakout to a new high that, when crossed, confirmed the start of a new trend. This concept was his primary tool for killing his own ego. He would never commit significant capital to a trade based solely on his own opinion that a stock was a buy. He would wait for the market itself to give him the signal. The breakout at the pivotal point was the market's validation, the objective external confirmation that his bullish opinion was now aligned with the dominant market force. It removed his personal judgment from the final decision. He was not the one deciding it was time to buy. The market was telling him it was time to buy. This process ensured that he was always trading based on evidence, not on ego. This same principle governed his exit strategy. If he was in a long position and the stock began to fall, violating a key support level, he did not see it as an opportunity to buy more at a cheaper price. He saw it as the market telling him that his initial thesis was now in doubt. He did not argue, he acted. He would sell the position, accepting that the conditions had changed. This intellectual honesty, this willingness to change his mind in an instant based on the market's action, is a defining characteristic of a winning operator. The loser is rigid, holding on to a cherished opinion. The winner is flexible, adapting their position to the ever-changing reality of the tape. This internal war between a speculator's ego and the objective truth of the market is the central, timeless drama of trading. The psychological conviction required to admit a mistake, to trust the market's verdict over one's own brilliant analysis, is immense. This struggle is captured with unparalleled clarity and brutal honesty in the single greatest book ever written on market psychology, Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The book, a thinly veiled biography of Jesse Livermore himself, is not a dry textbook of strategies. It is a living document, a direct look into the mind of a master operator as he battles the twin demons of hope and fear. It is a book that transcends time because it decodes the unchanging nature of markets and men, revealing the psychological traps that have destroyed speculators for centuries. But how can a century-old text be applied in today's high-speed markets? The original wisdom, while profound, can feel distant. For this reason, the single most valuable resource for the modern operator is the new 2025 Annotated edition, Reminiscences of a Stock Operator, an in-depth chapter-by-chapter analysis for the modern speculator by Max Davidson. This is not just the original text, it is a complete translation of its timeless wisdom. Max Davidson's detailed commentary in each chapter acts as a bridge across the century, making every one of Livermore's hard-won lessons immediately powerful and accessible for the trader of today. A link to this essential edition has been provided for you in the description below. It is the definitive guide to the psychology that every master must conquer. The fourth great sin that consigns the majority of traders to failure is the lack of a verifiable, positive mathematical edge. The losing trader operates in a state of strategic confusion. Their methodology is often a random, inconsistent collection of ideas they have picked up from various sources. They might use a moving average crossover one day, an oscillator the next, and a news-based trade the day after that. Their chart is often a cluttered mess of a dozen different indicators, each one occasionally giving a good signal but frequently contradicting the others. When they have a winning trade, they do not truly know why it worked. When they have a losing trade, they do not truly know why it failed. They have no way of knowing if their system is actually profitable over the long run. They are, in effect, navigating a statistical minefield without a map, operating on pure, unadulterated hope. The antidote to this strategic chaos is the scientific, systematic approach pioneered by Richard Dennis. Dennis, a legendary commodities trader, believed that trading was not an art form, but a science that could be taught. His entire philosophy was built on the concept of positive mathematical expectancy. A trading system has a positive expectancy if, over a large number of trades, it is statistically guaranteed to produce a profit. This is the only thing that separates professional speculation from pure gambling. A casino has a positive expectancy in the game of roulette because, over thousands of spins, the presence of the 0 and 0 guarantees the house will win. The professional trader must have a similar verifiable edge over the market. The formula for expectancy is simple but profound. Expectancy equals open parenthesis, win percentage times average, win size close parenthesis, minus open parenthesis, loss percentage times average loss. Size close parenthesis. The winning trader, the professional, has a deep quantitative understanding of their own system's expectancy. They know their historical win rate, they know the average size of their winning trades, and they know the average size of their losing trades. The losing trader knows none of these things. The turtle experiment was the ultimate proof of this concept in action. Dennis taught his group of novice traders a complete mechanical trend-following system. The system's rules were designed to produce a very specific mathematical expectancy. The win rate was low, often below 40%, meaning that the majority of their trades were small, manageable losses. However, the system's exit rules were designed to let winning trades run for as long as possible, making the average winning trade many, many times larger than the average losing trade. Let us use a hypothetical example. A turtle's system might have a 35% win rate and a 65% loss rate. The average loss might be capped at $1,000, but the average win, due to the system's ability to capture massive trends, might be $5,000. Plugging these numbers into the formula. Expectancy equals open parenthesis, 0.35 close parenthesis times $5,000 minus 0.65 times $1,000 equals $1,750 minus $650 equals $1,100. This means that for every trade this system takes, on average, it is expected to produce a profit of $1,100. $1,100 over the long run. This is the definition of a verifiable edge. The winning trader does not need to be a genius who can predict the market's next move. They need to be a disciplined operator who has found a system with a proven statistical edge, and then has the fortitude to execute that system flawlessly over a large number of trades, allowing the law of large numbers to work in their favor. The loser, with no defined or tested system, is operating with a negative expectancy. Their long-term failure is not a matter of bad luck. It is a mathematical certainty. We have now addressed the foundational sins of preparation and the strategic sins of analysis. We have learned the necessity of a plan, of following the market, of listening to the tape, and of operating with a verifiable edge. But even a trader with a perfect plan and a perfect analytical method can fail if they cannot master the third great domain, the art of execution. This brings us to the tactical sins, the fatal errors committed in the heat of an open trade, where risk management and position sizing become the only things that matter. The fifth sin, catastrophic risk management, the sin of recklessness. This is the single most direct and brutal cause of financial ruin in the markets. It is the point where the intellectual exercise of trading collides with the unforgiving mathematics of loss. The losing trader, even if they have a decent method for identifying opportunities, is almost always a catastrophic failure at managing risk. Their behavior is a textbook example of recklessness, driven by a profound misunderstanding of probability and a deep-seated desire for a quick, life-changing profit. This failure manifests in three key, often overlapping behaviors. The first is the complete absence of a predefined stop-loss. The amateur enters a trade with a clear idea of how much they hope to make, but only a vague, undefined notion of how much they are willing to lose. When the trade moves against them, they are paralyzed. They have no plan. They fall back on the most dangerous emotion a trader can have, hope. They hope the trade will come back to even. This hope is the psychological poison that allows a small, manageable loss to fester and grow into a devastating one. The second behavior is excessive position sizing. The losing trader, desperate for a big win, will often risk a huge and irresponsible percentage of their total capital on a single trade. They might risk 10, 20, or even 50% of their account on one idea. They do not understand the brutal mathematics of the risk of ruin. A single 50% loss requires a 100% gain on the remaining capital, just to recover. A string of just a few such losses mathematically guarantees a blown account, regardless of the quality of their trade ideas. The third, and perhaps most egregious behavior, is averaging down. When a trade goes against them, the amateur will often buy more, lowering their average price. This is an act of pure ego, a doubling down on a mistake in a desperate attempt to prove their initial judgment correct. It is the financial equivalent of accelerating into a wall, hoping the wall will break. The antidote to this entire catastrophic mindset is the defensive doctrine of Paul Tudor Jones. Jones, one of the most successful and durable macro traders in history, built his entire career on a philosophy of obsessive, paranoid, and non-negotiable risk management. His approach is not about making brilliant predictions. It is about surviving to trade another day. The first pillar of his doctrine is his famous 5-to-1 rule, which we have discussed before. But it is critical to re-examine it here as a risk management tool. By refusing to enter any trade where the potential reward is not at least 5 times the potential loss, he is systematically filtering out low-quality, high-risk trades before they can ever threaten his capital. He is only willing to expose his capital to risk when the odds are overwhelmingly skewed in his favor. This is the professional's first line of defense. a ruthless selectivity that eliminates most of the bad bets before they are even made. The second pillar is his ironclad rule of capital preservation. Jones operates with a strict mathematical limit on how much he is willing to risk on any single idea, typically no more than 1 to 2% of his fund's total capital. This is the mathematical foundation of his survival. It ensures that no single loss, no matter how painful to his ego, can ever inflict a mortal wound on his portfolio. It is the rule that guarantees his longevity. It allows him to withstand a long string of small losses, knowing that his capital will be intact and ready to be deployed aggressively when the next, true 5-to-1 opportunity presents itself. The final and most important pillar of his defensive doctrine is his absolute commitment to the predefined stop. Before he ever enters a trade, he knows the exact price on the chart where his thesis is proven wrong. This is his mental stop, his line in the sand. If the price touches that level, the trade is over. The decision to sell is not made in the heat of the moment, when fear and panic have clouded his judgment. It is a rational, pre-made decision. The execution is automatic and non-negotiable. This is the practical application of his other famous rule: don't ever average losers. For Jones, a trade moving against him is the market telling him he is wrong. His response is not to argue, but to listen and to act, preserving his capital and his mental clarity for the next battle. The losing trader focuses on the potential profit of a trade. The winning trader, like Paul Tudor Jones, is obsessed first and foremost with the potential loss. The sixth great sin is the losing trader's inability to do nothing. The amateur is addicted to action. They believe that to be a successful trader, they must be trading constantly. They are driven by a deep-seated fear of missing out, a restless impatience, and often a simple desire for the entertainment and the dopamine hit that comes from placing a bet. This activity bias is a guaranteed path to mediocrity and eventually ruin. It forces the trader to take low-probability marginal setups that do not meet the strict criteria of a professional. They are constantly jumping in and out of the market, getting chopped up by the random directionless noise that characterizes most trading days. They are bleeding their account to death not through one catastrophic loss, but through 1,000 small, unnecessary cuts in the form of commissions and small losses. They confuse activity with progress. The antidote to this compulsive need for action is the profound and deeply counterintuitive philosophy of patience, a principle most powerfully articulated by Charlie Munger. Munger, the intellectual architect of Berkshire Hathaway, believed that the greatest fortunes are not made by frantic activity, but by long periods of intense study and patient waiting, punctuated by rare and decisive moments of action. His most famous and most characteristic piece of advice on this subject was simple: practice, sit on your ass investing. This is a philosophy of extreme selectivity. Munger understood that truly great, once-in-a-lifetime investment opportunities are exceptionally rare. They do not appear every day or every week or even every year. The great mistake that most investors and traders make is feeling that they must have an opinion on everything and that their capital must always be fully deployed. Munger's approach was the opposite. He believed in doing the exhaustive, multidisciplinary research to understand the world, and then waiting, with the patience of a predator, for the perfect opportunity to appear. He and Buffett often used the baseball analogy of the fat pitch. In investing, you are in a game where there are no called strikes. You can stand at the plate and watch thousands of mediocre pitches, overvalued stocks, complex situations, businesses you don't understand, go by without ever having to swing. There is no penalty for inaction. Your job is to wait for that one perfect, fat pitch right in your sweet spot, the one rare, obvious opportunity where you have an enormous edge. It is only then that you swing, and you swing with maximum force. Overtrading is the equivalent of swinging at every pitch, a strategy that guarantees a strikeout. To operationalize this patience, Munger employed a simple but powerful mental tool: the too hard pile. He recognized that the vast majority of investment opportunities were simply too complex, too unpredictable, or too far outside his circle of competence to be analyzed with any degree of certainty. The key to his success was his intellectual humility. He was brilliant at quickly identifying these too hard situations and immediately throwing them into a mental discard pile, freeing up his mental energy to focus only on the rare, simple, and obvious opportunities where he had a clear, demonstrable edge. This philosophy also changes one's perception of cash. For the amateur who needs constant action, a cash position in a portfolio is a source of anxiety, a drag on performance. For Munger, a large cash reserve is a strategic position of immense power. It is the physical manifestation of patience. It is the optionality that gives an investor the power to act with overwhelming force when the rest of the world is in a state of panic and Mr. Market is offering up those rare, fat pitch opportunities. The losing trader is always busy. The winning operator, like Charlie Munger, understands that the most profitable action is often no action at all. We have now dissected the foundational, strategic, and tactical sins that lead to the ruin of the majority of market participants. We have explored the fatal consequences of operating without a professional plan, of ignoring the market's primary trend, of arguing with the objective evidence of the tape, and of trading without a verifiable statistical edge. We have also deconstructed the tactical errors of catastrophic risk management and the impatient, compulsive need for constant action. An operator who has absorbed these lessons and implemented the proposed antidotes, the discipline of Baruch, the market awareness of O'Neill, the egoless execution of Livermore, the systematic approach of Dennis, the defensive doctrine of Jones, and the profound patience of Munger, has already elevated themselves far above the amateur crowd. They have a plan, they have an edge, and they have a system for managing their trades. Yet, even with this complete arsenal of professional tools, failure is still possible. For we now arrive at the final and deepest layer of errors, the source from which all other mistakes ultimately spring. This is the domain of the psychological sins, the great internal war that every market participant must fight every single day. These are not errors of strategy or tactics, but errors in the very wiring of the human mind. Mastering this final domain is what separates the merely competent from the truly legendary. The seventh and most elemental sin is the failure to control the two primal emotions that govern all financial markets: fear and greed. These are not character flaws. They are deep-seated evolutionary survival instincts that have been honed over millions of years. Greed is the instinct that drove our ancestors to acquire and hoard scarce resources. Fear is the instinct that kept them safe from predators and environmental threats. These instincts were essential for survival on the savannah, but they are dangerously and catastrophically mismatched with the abstract, probabilistic world of modern finance. The losing trader is a slave to this ancient wiring, while the winning investor learns to recognize and neutralize it. Greed is the engine of the bull market's final, most dangerous phase. For the losing trader, it manifests in several predictable and ruinous behaviors. The most common is the fear of missing out, or FOMO. When a stock or an entire market is in a parabolic advance, the amateur is overcome by an irresistible urge to participate. They abandon their plan, their research, and all semblance of discipline, and they chase the price higher, buying into the peak of the speculative euphoria. Greed also manifests in the refusal to take a reasonable profit on a winning trade. The trader, seeing their profits grow, becomes hypnotized by the possibility of even greater, faster gains. They abandon their sell discipline and hold on, convinced the stock will go to the moon. Greed is also the primary driver of the reckless use of leverage and the taking of oversized positions. It is the voice that whispers, "This is the one," encouraging the trader to abandon all principles of sound money management in the pursuit of a single, life-changing score. Fear, on the other hand, is the engine of the market crash. For the losing trader, it is the force that guarantees they will buy high and sell low. In a declining market, fear grips the amateur. The pain of their losses becomes unbearable, and their long-term perspective collapses into a desperate, short-term need to stop the pain. This is what leads to panic selling, the act of liquidating one's holdings at the absolute bottom of a crash, often locking in the maximum possible loss. Fear also manifests as decision paralysis. At the very moment of maximum opportunity, when the market is offering generational bargains, the fearful trader is unable to act. They are paralyzed by the terrifying headlines and the overwhelming consensus of pessimism. The fear of being wrong, of buying too early, prevents them from taking the very actions that are necessary for long-term success. The most powerful antidote ever devised for this emotional roller coaster is the philosophy of Benjamin Graham, the father of value investing. His entire system was designed not just as a financial methodology, but as a complete psychological framework for neutralizing the destructive power of fear and greed. His first great tool, as we have discussed, is the margin of safety. This is the ultimate defense against fear. By insisting on buying an asset for far less than its intrinsic value, the investor creates a psychological buffer. The fear of a price decline is dramatically reduced when you know, with a high degree of certainty, that the underlying value of your holding is significantly higher than your purchase price. It is this confidence in the underlying value that gives the intelligent investor the courage to be a buyer when the rest of the world is selling in a panic. His second and even more profound tool is the allegory of Mr. Market. This is a cognitive reframing of the entire investment process. By personifying the market as a manic-depressive business partner, Graham teaches the investor to detach from its emotional swings. The euphoric high prices offered by a greedy Mr. Market are not a signal to jump in, but a generous opportunity to sell. The despondent low prices offered by a fearful Mr. Market are not a signal of impending doom, but a rare and wonderful opportunity to buy. This framework fundamentally inverts the amateur's emotional responses. It trains the intelligent investor to view the market's greed with skepticism and to view its fear with avarice. It is the ultimate tool for transforming the market's greatest psychological weaknesses into one's own greatest strategic strengths. We now arrive at the final, deepest, and most difficult sin to confront. It is the failure of the trader to understand their own true subconscious motivations. The losing trader often believes they are in the market to make money, but their consistent self-destructive actions tell a different story. This is the radical and uncomfortable insight of the great systems trader, Ed Sikota. His entire psychological framework is built on one of the most profound and provocative statements in all of finance. Everybody gets what they want out of the market. On the surface, this statement seems absurd. No one consciously wants to lose money. But Sikota's insight operates on the level of subconscious intentions. He argued that a trader's results are a direct and perfect reflection of their deepest and often hidden desires. If a trader on a subconscious level is not seeking consistent, methodical profits, but is instead seeking the thrill and drama of high-stakes gambling, they will unconsciously make decisions that provide that thrill. They will break their rules, take oversized positions, and chase volatile markets, because the emotional payoff of the action is more satisfying to them than the financial reward of discipline. The inevitable blown-up account is not an accident. It is the fulfillment of their subconscious desire for excitement. Sikota identified other hidden wants. Some traders, he argued, have a deep-seated need to be a victim. They want to be able to blame the rigged market, the crooked brokers, or the powerful insiders for their failures. This allows them to avoid taking personal responsibility for their own decisions. They will, therefore, subconsciously find a way to lose money, as this fulfills their narrative of being a victim in an unfair world. Others have an overwhelming ego-driven need to be right. They would rather lose money on a trade than admit that their initial analysis was wrong. They get the deep, psychological satisfaction of being able to say, "I told you so," even as their account dwindles to zero. Their subconscious want is for intellectual validation, not for financial profit. The antidote to this sin of self-sabotage is radical self-awareness. Seikoda's philosophy demands that a trader engage in a process of deep and often uncomfortable introspection. They must ask themselves, what do I really want from the market? Is it profits, or is it excitement, drama, or the validation of a victim narrative? He even developed a unique process called the trading tribe to help traders in this journey. It is a form of peer-to-peer group work where members help each other to uncover and address the hidden, subconscious drivers behind their self-sabotaging trading behaviors. The ultimate goal is to achieve a state of congruence, where the trader's conscious goals to be profitable are in perfect alignment with their subconscious intentions. For Seikoda, it is only when this internal alignment is achieved that the effortless, disciplined execution of a winning system becomes possible. We have now deconstructed the 8 great sins that lead to the failure of the 95%. They form a chain reaction of disaster. The foundational sins, the lack of a professional plan and an ignorance of the market's trend, leave the trader rudderless. The strategic sins, the ego-driven argument with the tape and the hopeful lack of a verifiable edge, leave them without a compass. The tactical sins, catastrophic risk management and the impatient need for action, ensure their ship will sink in the first storm. And the final psychological sins, the slavery to fear and greed and the ignorance of one's own subconscious intentions, are the deep, internal currents that drive the trader towards the rocks again and again. The path to the winning 5% is therefore not about finding a single secret indicator or a magical formula. It is a comprehensive journey of professionalization. It is about building a robust, evidence-based framework for analysis and execution. But most importantly, as the greatest legends have all demonstrated, it is a journey of self-mastery. It is about cultivating the discipline, the patience, the intellectual honesty, and the self-awareness required to overcome the powerful, innate, and destructive biases of the human mind. The market is, and always will be, a mirror. The losing trader sees in it a reflection of their own chaos and emotional turmoil. The winning operator, through a lifetime of dedicated work, learns to see in it a reflection of their own discipline, patience, and rationality. Before we conclude, we want to extend our gratitude to you, our viewers. We put an immense amount of research and effort into creating these deep dives, and your engagement is what makes it all possible. To everyone who watches, who subscribes, and who takes the time to leave a thoughtful comment, thank you. Your participation is what helps these videos reach a wider audience on YouTube. A special thanks is due to those of you who have supported the channel through the Super Thanks feature. Your direct support is a powerful motivator for us to continue this work and to keep raising the bar on the quality of our analysis.